The yield is not the danger. The danger is when the ETF pays you with one hand and quietly shrinks with the other. And right now, millions of investors are holding funds that do exactly that. Here's what I mean. Say you invested $10,000 in one of the most popular high-yield ETFs about 10 years ago. Every month, a check lands in your account. You've collected roughly $14,000 in distributions over a decade. Sounds great, right? But here's the part nobody shows you. Your shares, the actual position, are now worth about $6,500. You got paid $14,000. You lost $3,500 on the investment itself. The monthly checks felt like income, but a chunk of that money was your own capital coming back to you. That's not income. That's a slow leak. Now, before I tell you which ETF that was, take a guess. How much do you think $10,000 invested in a 12% yield ETF would actually be worth today after a decade? Hold that number in your head. Today, I'm putting 7 of the most popular high-yield covered call ETFs through a 5-point test: income paid, price trend, total return, distribution consistency, and tax efficiency. The 7 ETFs are QYLD, RYLD, XYLD, JEPI, JEPQ, SPYI, and QQQI. By the end, you'll know exactly which ones are real income machines and which ones are quietly leaking your money. And I'll give you a framework you can use on any high-yield ETF you ever look at. And one of these ETFs, the one with the biggest distribution rate, has a hidden advantage that most people completely miss. I'll get to that. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Let's get into it. Test 1. What does the yield actually put in your pocket every month? First test, what does the yield actually put in your pocket every month? Let me break down all 7 ETFs. I'll give you the yield, the expense ratio, and the options strategy because the strategy is what determines everything else. Starting with the Global X family, these 3 all use the same approach, at-the-money covered calls. That means they sell call options at the current price every single month. They collect the premium, but they give up 100% of the upside. QYLD tracks the NASDAQ 100, yield around 11.4%, expense ratio 0.60%, over $8 billion in assets. RYLD tracks the Russell 2000, yield around 11.6%, same expense ratio 0.60%, about $1.4 billion in assets. XYLD tracks the S&P 500, yield around 9.3%, expense ratio 0.60%, about $3.2 billion in assets. Now the JP Morgan funds, different approach. These sell out-of-the-money calls through equity-linked notes. That means they keep some of the upside when the market goes up. JEPI tracks the S&P 500 actively managed, yield around 8.1%, expense ratio just 0.35%, lowest in this group, nearly $45 billion in assets, the giant of the category. JEPQ tracks the NASDAQ 100, also actively managed, yield around 10%, same low expense ratio, 0.35%, about $41 billion in assets. And then the NEOS funds. These use call spreads on index options, a different structure entirely. I'll explain why that matters for taxes in a few minutes. SPYI tracks the S&P 500, yield around 12%, expense ratio 0.68%, about $10 billion in assets. QQQI tracks the NASDAQ 100, distribution rate around 14.3%, same 0.68% expense ratio, over $13 billion in assets. Launched in January 2024, so it's the youngest of the group. Now, here's what this looks like in real dollars. On a $100,000 investment, JEPI pays you roughly $675 a month. JEPQ pays about $830, QYLD pays around $950, SPYI pays about $1,000, and QQQI pays roughly $1,190 a month. Big spread. But here's the thing, before we go deeper, let me ask you this. When you look at an ETF like this, do you check the yield first or do you look at the price chart first? Think about that, because by the end of this video, you'll know which one actually matters more. Those monthly income numbers look great on paper, but one of these strategies is literally designed to give up every dollar of upside in exchange for that premium, and over a decade, that design choice has cost investors a fortune. Let me show you. Test 2. Is the fund shrinking? This is the test that separates income machines from portfolio leaks. NAV, net asset value. It's the share price of the fund, and if the NAV is dropping over time, that means the fund is paying you with money it's pulling from the value of your investment. That's not income, that's a refund of your own capital. So let's check all 7. QYLD. Launched at $25 a share, today it's around 18.46. That's a 28% decline. Some analysis puts it closer to 35% depending on the measurement window. Meanwhile, the NASDAQ 100, the index QYLD tracks, roughly tripled over that same period. The fund's strategy surrendered every dollar of upside every single month for over a decade. Remember that guess I asked you to make? Here's the answer. $10,000 in QYLD 10 years ago, your shares are worth about $6,500 today. You collected $14,000 in checks. The same $10,000 in QQQ, the plain NASDAQ 100 index fund, would have tripled your money, and you still could have taken periodic withdrawals that exceeded what QYLD paid. RYLD, the worst performer in this group. Since inception, the average annual return has been just 5.72%. Morningstar gives it a negative medalist rating. The Russell 2000 has underperformed large caps for years, and the at-the-money covered call strategy piles on additional drag. XYLD, roughly flat to slightly declining, better than QYLD, but the same at-the-money strategy still caps all the upside on the S&P 500. Now, the other side. JEPY. NAV has been roughly stable since launch, not appreciating much but not leaking either. JEPQ, NAV has actually been going up. The fund captures partial upside because it sells out of the money calls, not at the money. Big difference. SPYI. NAV has held essentially flat since its August 2022 launch while paying a 12% distribution. That's the combination income investors want: stable principal plus high cash flow. QQQI. NAV has been appreciating. $10,000 invested at launch in January 2024 grew to about $16,350 by June 2026. That's total return, income plus growth. The fund actually outpaced the S&P 500 total return over that stretch. Now, here's the myth I want to clear up. Here's the myth. High yield means high income. Here's the truth. A high yield on a shrinking fund means shrinking income. QYLD paid 18 to 25 cents per share per month back in 2018. Today, it's paying 16 to 19 cents. The yield percentage stayed about the same, but the actual dollars you received went down. The denominator shrank. That's the leak. So now you know which funds are shrinking and which aren't, but NAV trend alone doesn't give you the full picture. There's one more number that tells the complete story, and it's the one number most yield chasers never check. Test 3. Total return, the honest scorecard. Total return is everything, share price movement plus every distribution you received. It's the only honest way to compare these funds. Here's why. A fund that pays 12% but loses 4% a year in NAV has a real return of about 8%. A fund that pays 8% but grows 3% has a real return of 11%. The lower yield actually made you more money. So let's run the numbers. Average annual total return since inception for each fund. QQQI, about 20.9%, the leader by a wide margin, though it has the shortest track record. JEPQ, about 16.3%, the strongest total return among funds with a meaningful track record. SPYI, about 14.8%, impressive, especially while maintaining a stable NAV and 12% distribution. JEPY, about 10.8%, solid, not spectacular. The low volatility approach means less upside capture. QYLD, 8.8%. That 11% yield looked great, but the total return tells a different story. XYLD, 7.9%, and RYLD, 5.7%, the worst in the group. Notice the pattern. The hierarchy is nearly the inverse of the yield ranking. The funds with the flashiest yields delivered the weakest total returns. The funds with more moderate yields, JEPQ, SPYI, QQQI, delivered significantly stronger wealth creation. Quick question before we move on. Which of these 7 ETFs do you currently own or are you thinking about buying? Drop it in the comments. I read every single one. So the total return picture is clear, but there's one more dimension most people completely ignore, and for investors in taxable accounts, it can change the math by thousands of dollars a year. Tests 4 and 5. Consistency, taxes, and fit. 2 final tests. First, distribution consistency. How smooth are the payments? If you're budgeting around this income, predictability matters. JEPI's monthly payments ranged from 33 cents to 54 cents per share in 2024. That's a 66% swing. If you built your budget around the 54-cent month, the 33-cent month would have been a problem. QYLD's payments have been more consistent month to month, but they've been consistently declining year over year as the NAV drops, so you get stability in the short term with erosion in the long term. SPYI and QQQI have been relatively consistent since launch, though both are young funds without a full market cycle behind them. Second, taxes, and I think most people get this backwards. The NEOS funds, SPYI and QQQI, use index options that qualify as Section 1256 contracts. That means 60% of the gains are taxed at long-term capital gains rates, no matter how long you held the fund. The other 40% is taxed at short-term rates. That's a meaningful advantage over ordinary income. JEPI and JEPQ distributions are taxed as ordinary income. If you're in the 32% federal bracket, an 8.5% yield becomes roughly 5.8% after federal tax, before state taxes. Now here's where it gets interesting. When you see return of capital on an NEOS fund's distribution, most people think red flag. But for SPYI and QQQI, that's actually the tax efficiency working as designed. Return of capital reduces your cost basis instead of triggering immediate income tax. You defer the tax until you sell, and when you do sell, you may pay the lower long-term capital gains rate. So the fund that looks worst on the label might actually put more money in your pocket after taxes than the one that looks cleanest. That's a big deal for anyone investing in a taxable brokerage account. So now you've seen all 5 tests: income, NAV trend, total return, consistency, tax efficiency. Let me put the full scorecard together. Income machines versus portfolio leaks. Here are the results. Tier 1, income machines. These pass the yield test. JEPQ, strong total return, about 16.3% per year since launch, NAV appreciating, best balance of income and growth in this group, low expense ratio at 0.35%. The trade-off, distributions are ordinary income, so it's better suited for tax-deferred accounts like an IRA or 401k. SPYI, NAV stable, roughly 12% yield. Section 1256 tax advantage makes it the strongest pick for taxable brokerage accounts. Solid total return at about 14.8% per year. The expense ratio is a bit higher at 0.68%, but the tax savings more than offset it for most investors. QQQI, the highest total return in the group at about 20.9% per year. NAV appreciating. Tax efficient like SPYI, but, and this matters, it launched in January 2024. That means it hasn't been tested through a real bear market. High conviction, but keep your eyes open on this one. Tier 2, middle ground, conditional pass. JEPI, stable NAV, largest fund in the category at nearly $45 billion, lowest expense ratio, longest track record among the newer generation of covered call ETFs, but total return is modest, about 10.8% per year, and distribution swings are real. A solid foundation, not the star. XYLD, roughly flat NAV, decent consistency, but total return of 7.9% per year lags significantly. The at-the-money strategy on the S&P 500 is less destructive than on the NASDAQ, but it still caps meaningful upside. Tier 3, portfolio leaks. These failed the test. QYLD, NAV down 28% since inception, distributions shrinking in real dollars year after year, total return of 8.8% per year, barely above a high-yield savings account when you account for the volatility. The yield looks high because the denominator keeps getting smaller. That's the definition of a portfolio leak. RYLD, worst total return in the group at 5.7% per year. Negative Morningstar rating, smallest fund. The Russell 2000's underperformance compounds the covered call drag. There are better options. And here's the line I want you to remember. The yield is the advertisement. The total return is the truth. Write that down. Screenshot it. Tell it to anyone you know who picks ETFs by sorting highest yield first. Smart investors don't chase the biggest number on the label. They run the test. Income paid, NAV trend, total return, distribution consistency, tax efficiency. 5 checks, takes 10 minutes, and it tells you more than any headline yield ever will. If someone you know is investing in covered call ETFs and hasn't looked past the yield, share this video with them right now. It could save them thousands. Now tell me, which tier did your ETF land in? Income machine, middle ground, or portfolio leak? Drop your answer in the comments. If you're building income from your investments and want to stay ahead of changes like this, subscribe to this channel and hit the bell so you don't miss the next one.